All right. Well, we finally got. It took it took a while, but we finally got the market outlook here posted. I've been yesterday. I didn't have internet access for a while, and the camera's not working. I've been trying to get the camera to work, and for some odd reason, it's not been working today. And The computer system has been programs won't work. I think there's some platform wasn't working for me because of the my computer system. I've had to restart and do different things, and it's just been one heck of a day, and for that matter, night as we're finishing up here this morning. So we finally got it done. I finally got at least some version of it done. A little bit of a makeshift version today. It's not the same, but it's something we can get out to you ahead before the market opens here, and kind of get an idea of what happened last night, or yesterday. Let's go ahead and get started. Today is Wednesday, October the 2nd, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start out taking a look at the market forecast indicator on the S&P 500, as we always do. And there's our day today. A little bit of a long lower shadow, but not long enough to say that this is like the low point of the day. There's going to be some other things we take a look at here in just a second. You can see how we broke here yesterday. We were kind of at some support here at that 38, a little bit below this 38% Fibonacci, 23% Fibonacci retracement levels. Obviously now gone all the way back down into this. So there's some significance at this level here, right around 28.87. If you look at SPY, you will see here this level here at 288.06, 287 to 288. If you take a look at it on the Bollinger Bands for SPY, you'll notice that that's where this point of control is. So there's an important layer of support that we're sitting on pretty much right now. That if we hold, there's a good chance that this selling holds. And again, here's the reason why we can't just completely fall off a cliff here and drop off to the downside like we did, say, for example, last October. You see all this volume that we have below us now. If I were to go back here to last October, so let's go back to, say, when it really started to sell off here, and we'll go back to, like, say, August the 9th, let's go back to August the 9th, August the 10th, and then the 11th. So we'll do a custom time frame here of August the 11th of 2018. We'll do a 1-year chart. So we'll go August the 12th of 2017 and take a look at its volume profile of what it looked like there. And you can see how we still had room to go down. We were so far up above on August the would be August the 9th. Let's go to August the 9th versus August the 10th there. Look how far up above we were, the point of control. We had a lot of room just to get to the value area at 280, much less go beyond down to 267. Right. Well, lo and behold, we finished that day at 287. Again, 280 is where layer support is, and then 272 and 267. So now I go back to the Bollinger Bands here. Go back a couple of years, and you can see, we came all the way down to 272, right? So 280, we blew right on through, right there. And then we went on down to 272 and ultimately down to a little bit past 267 where that point of control is. So we moved down that fast. Well, now we fast forward to this year and we are at the point of control right now. And a lot of volume here, 280 is where another layer is. So you can see how much different environment now. We were well above the value area last October. We were bullish for so much longer than we were this go around. And you can see, we've dipped below the Bollinger Band here, and we've done that before in May, and that set a little temporary low point. We did diverge to a lower low but again, it wasn't anything. It was just an intermediate pullback at that point. Very, very possible that something like that can happen again, considering what the chart's looking like. So let's go back to the market forecast for the SPX. And again, short-term sentiment, down to extreme lows, following up yesterday's extreme low on the momentum line with a pretty bearish dip on the near-term line. The lowest dip that we didn't even get this low on this pullback. So the posture is looking like it's going to turn strongly bearish. It has for the Russell 2000, and we actually have the bearish pattern here of dark pink shading and red line, and you have that for the NASDAQ composite as well. You don't quite have it yet for the Dow Jones. It's actually looking less bearish in all of them, but we're getting more bearish. The issue is how extreme the selling has been, and whether or not we can sustain such extremes to the downside. Like before, when we get these extremes, they tend to set the low points when we see them. All right, let's take a quick look at the long-term chart for the S&P 500, and you can see the bearish candle. If I look at the regular, there's another reason why we stopped where we did, because that is where the 200-day, or at least in this case, the 40-week exponential moving average is sitting. So we've touched that before a couple of times here before bouncing right off of it. When we close down, of course, we still have 2 more days left this week to see if we actually close down or if we end up with a long lower shadow like we did back in early August before finishing a week at the 200-day and then bouncing off of that. So we'll kind of keep our eyes there on that. Again, considering the extremes of these couple of days drop makes it more likely that it's going to be hard to sustain it. It's easier when it's not so bearish. We can stay down for a few weeks. The big weeks to the downside, we tend to find buyers in those scenarios. Take a look at the 3 green arrow chart. Here is that's the market forecast. Sorry, this one right here. 3 red arrows, obviously. We got 3 red arrows yesterday, and now we've gone down more with the red line. This is what the 2-line version looks like for that chart. Give it a second here. There we go. You can see the 8-day now has crossed below the 17 or the 30, but not the 17. So the 8's crossed below 17. The MACD's crossed below 0. That's what that means. The histogram is obviously very negative. Some of it's almost as negative as what we got over here, again, where we set the lows. The orange line's not below. So just like over here where the blue line dipped above, but the orange line never got up above. So we never did get the reversal to the upside before falling. That's the same thing here. We got pretty much up above the 30. Over here we got well above the 30 before we rolled over. So just getting above the 30 doesn't mean we're reversing, right? Especially unless that orange line comes through, which probably won't take. Barring a big move to the upside tomorrow or Friday, probably will get that orange line to come down. So we'll kind of keep our eyes there on that as well. That would be kind of your last area of confirmation that will be bearish here for a while. The intraday chart here, you can see the range. You see how, because we fell so far and we developed some volume in here, again, it makes it really easy to fill in this volume to the upside. So something else to watch again as early as tomorrow, Friday, for us to fill in that volume now up to the upside that we have. If I take a look at the 90-day chart here and go back a little bit further, now you can see where that volume's at here, and pretty much the bottom of the value area for the 90 days is where we stopped. So now again we fall through here. It's very easy to move to the downside. A little bit of a support at 285, very little volume down here on an intraday chart. Of course, the further out you go and you're getting some volume in this area, the value area is down to 277, 280. Of course, the daily charts, the more significant, it's mostly viewed, and of course 280 is where I'd say your next, if we break in this area, is your next layer of support on that. Again, you expect support to hold until it doesn't, and if it doesn't, 280 is on the table. about another $8 away from where we're at right now. Let's take a look at the trading range and the volume today. SPY, here we go. So 4.87 points, but you have to include the gap. So we close at 293.24, the high at 291.51. So about 2 points almost of gap. So you're almost 7 points trading range. And you can see the volume at 124 million. Pretty decently high, 1.5 times the average volume. You put that into context here, and you can see that the volume 124 million is up here, pretty bearish. 7 points is well outside of this, so just under 7 points. See the high levels, they're all rising, so it's pretty bearish. But again, that's the most extreme we've seen. Yesterday's move with no gap, we had a range of 5.5 points, so much bigger range, more volume than we've seen. We'll see if that, like I said, ends up being setting the low point or not. What's interesting to see is that the volatility index is not really confirming this. Whereas if I were to look at previous times where we've been this bearish, here's in May, you can see we got up to extreme lows on August the 5th. We got up here to extremes in May the 9th, May the 10th. Then we set a new low point right there at the end of May. All of those got above 100%. This one just got to 100%. So the markets aren't nearly as worked up about this jump in volatility, which, in the past, that just makes it a really easy volatility jump to sell. That's something we teach in our options inventory trading class, is to take advantage of moves like this and to sell that and sell. You get good pricing, you get good premiums, and you can see most of the days volatility, unless you really take off, which we're not, because we're not surging above 115%, which is what happened here. So unless we do that and we surge above 115% and we kind of set a new high in volatility, then we tend to jump and then fall down and jump and fall back down and jump and potentially fall back down again. As of right now, the trend strength indicator tells us we do have a weak bearish trend, so we are below -1 and we are above 50, so we have a weak bearish trend developing, and we are down below the Ichimoku cloud. Again, this is the inflection point. We are literally at that point of control on the daily chart. A break down below that puts 280 on the table, and now we have a much stronger bearish trend. So very, very important to see what happens at this level here in the very near term. Let's take a look at the DMI index for the S&P 500. Let's go to SPX. You can see that the negative line is well above 25. The positive line is well below 20. The ADX is rising and making its way up above 20. So that's a little bit of a, you can see the last time we had that big of a divergence is right here, and that set the low point at the time. Now we had some ups and downs, but that pretty much set the low point when we had this type of divergence, this extreme just quickly. Again, very similar. See if we end up having this very similar pattern develop now with this little drop that we've had over the past couple of days. Finally, the trend, which measures the not only the advanced decliners but also the volume of advancers versus decliners, and you can see it's really, really high. In fact, the 10-day moving average is up to almost to 1.4. Values to these peaks tend to set low points themselves. Didn't quite get to 2. That's the extreme. This one got over the 4, and that really set the low point there in mid-August. So we're not that high, but we are above this 1.5 level. Excuse me, we are above the 1.5 level, and that, that's a high level. It's a high watermark. This blue line was set here at the at what the 10-day moving average was. It's now at 138. Just to kind of show you in the past of how often this gets this high. The last time was right here, this peak, and that set the low point there. And if I were to go back further again on the daily chart, you can see, in 2018 we never got this much volume in sellers versus advancers. In 2017 we did, and that started us off on it wasn't that much of a pullback. We had a pretty bullish move to get to that point. It wasn't much of a pullback, but it was a lot of volume in the pullback, and that set us up for a new significant rally to the upside. Before that, the last time was in early 2016, and that set a low point that eventually we rallied significantly up from, and that was a much steeper and deeper rally than what we had this go around, and of course also in 2015 even more so. So it's not too often we get the 10-day moving average getting to this level. Tends to be pretty bullish for the markets going forward. Maybe not the next day or the day after, but we might go down a little bit more, similar to what we did in May by the time we got to the end of May and set the low point. But it does tend to, when this line's this high, it does tend to set us up for a pretty decent extended move up to the upside. And considering the seasonality of the fourth quarter, that's, you can kind of see we might be producing, we might be getting the low that you'd want, the pullback that you want to be able to get into that intermediate trend. Usually a lot of times when people say, well, I know it's about to make a run, and if we can just get a pullback, then I can get in at cheaper prices. And then when that pullback comes, we think, oh no, the market's in recession or bear market mode now. So then we never take advantage of what we were saying that we wanted to get bullish. And that might be the case right now. This might be the pullback that a lot of people say they want to see before they get into some equities, before they make a decent run, according to some of these indicators. All right, now let's take a look at what's driving the price action today. And one of the things that's interesting that doesn't get talked about too much, the main thing today was the ADP employment report from a news perspective. And that came in better than expected, but less than what it had. Now, the prior number got revised downward quite a bit, so it wasn't as big of a drop from the revised number, but a pretty big revision to the downside. But if you look at the economic surprise index, the last so many, this is a rolling 3-month window of indicators, and we are more positive than we've been all year in 2019. So the macro picture, as bad as the ISM number was here yesterday, getting to a significantly low level, the ISM, the other manufacturing indexes were not nearly as poor, and you can see construction spending as well. Another element, year-over-year change improved, still negative, but improved, not as negative as it was. So there are some indicators, and for the most part, the indicators are actually better than what their expectations are. Even the ADP beat expectations and didn't drop as much as what analysts had expected. Based on this ISM, mostly, you can see the odds for rate cut in December, by December, have jumped up to pretty much about 88%. That sets your April meeting here. You can see the odds of getting 2 cuts now are the inverse of that 25%, so 75% odds of getting a second cut by next April. So that's jumped up a little bit to the upside. You can see the GDP estimates updated a couple days ago are sitting right around 2%. So it's not like we are significantly dropping towards recession levels here. Let's take a look at TNX. And you can see the 10-year yield is dropping back down towards 1.6%. Again, we were kind of expecting at least one more cut anyway, and for yields to stay down until we get that last cut, and that's when yields start to take off. Take a look at the dollar index. Remember, everything's relative. The dollar index pulling back a little bit, but still above 99, so still holding the breakout that it's had. And it's had a pretty significant breakout here to get beyond 98, which was a key level of resistance, and now beyond 99, and also holding the breakout and continuing to trend its way up to the upside. Here's the trend strength indicator. Type in the symbol, you can see just how bullish, the pullback basically getting down to the Tenkan line. Very strong trend, and this strong trend can last a while. We'll see if it's the first strong bullish trend that we've had since back over here, and it took a little bit of time to an expiration date into the fourth quarter of last year. Of course, the biggest losers, or one of the big losers today, was crude oil. Crude oil really breaking down after that Saudi Arabia attack, now dropping all the way down to the bottom end of the Fibonacci retracement zone. So you're going to find some support here right around $51.5. In the past, that's led to move to the upside of this channel, and we haven't broken out of this channel one way or the other. So kind of be a little skeptical of any move, especially when you have such a weak posture that we have. Actually, it would be moderately strong, but not very strong yet. So be a little skeptical of any moves until you break out of this little sideways trend that it's been in. Let's take a look at the different foreign markets. So let's go to this one right here. Here we go. So you see you got one dark pink shading in China. You got a yellow line though, so you don't have the combination of dark pink and yellow line. Everything else is light pink except for Japan, and Japan still got a strong bullish posture and a green line. Everything else, you got yellow lines all over the place. Red line in Brazil down at the bottom, and a red line for the S&P 500 at the top. So pretty broad sell-off from a global standpoint here, with everything at the very least weakly bearish, with China being the most bearish right now and Japan being obviously the least bearish right now because it's got the stronger trend that it's been riding. Let's take a look at the sector rotation. Here we'll take a look at the 12 grid for the different sectors. You can see the cyclical sectors across the top, a couple of them in strong bearish postures right now with red lines. Energy sector, of course, struggling, down 10.5%. It's down the most here. Healthcare, you can see hitting 3-month lows. So a real significant drop. Dark pink shading, red line on healthcare. Real estate also finally in the dark pink shading. It's been a while for that industry. You can see utilities is still strong. So utilities has held up, where its partner in crime, and for that matter staples as well, have been dropping down to varying degrees. So again, when markets get really bearish, everything goes down together and the correlations go up and get stronger. That wasn't necessarily the case before, because some of these areas went up while stocks go down. When you're looking for stocks to hit a low and set a low, you want them all to go down at the same time. That's the preferred pattern, because then that makes our correlation stronger with each other. Again, they go down altogether, they tend to bounce back up altogether and make really good runs off of those lows before you start seeing those correlations break back up again. This is what the 3-month chart looks like. Again, you can see this isn't your typical bullish pattern or bearish pattern to see this chart heading into a bearish move. You tend to see cyclical areas up here at the top, and then they roll over. So keep that in mind too, in terms of how bearish we are. You have your dollar sensitive areas. You have pretty much everything that was bearish over here is bearish over here too, to the upside. And everything that held up over there is still holding up now. And they just happen to finally be pulling back now, whereas they held up and actually went up during some of these pullbacks over here. All right, one of the sectors that struggled yesterday is that financial sector. You can see it had the worst performance, or second worst performance, outside of the energy sector. Of course, it struggles. You have the brokerage area struggles that we all know about, involving TD Ameritrade here, as well as E-Trade and Schwab. But you also have struggles from the yield curve, the yield spread, as well as the yields themselves continue to falter, and that's putting pressure. That's the other way to make money for these companies, and that's not moving higher either. So when you look at a stock like JP Morgan here as a representative, you can see it's struggling. Now, they've got earnings coming up here pretty soon, so keep that in mind. But they've been struggling, and they're moving to the downside towards the bottom end of their range, which is down here towards 105, 106, 104 in that area. So if you look at the market forecast chart, you can see the pullback. We got the light pink shading and the yellow line. It's typically a pretty bullish pattern, actually, for a buy the dip type signal. You can see the MACD is close to crossing over below 0. The stochastics is close to crossing over. You look at some of these other indicators like the Bollinger Bands, and you can see we're also sitting towards a support level. We're breaking down below this volume node. The next node isn't until you get down to 109. So there's kind of some expectation now, if we get through this little value area, that it will struggle and work its way down to the bottom. You can also see too, from a Keltner channel standpoint, we are breaking down below that lower band. And in the past, you can see that's been a bearish sign for the stock. When it's been above the band, and then it's kind of worked its way inside and then broken down. We've seen this multiple times for this stock. A lot of it because of the fact that yields as a whole have been unable to really get going here. So at times it puts pressure on the industry. You can also see too, it's around earnings. This one had a positive earnings result, but it didn't last very long before it fell back down. Over here had a relatively positive earnings, and then it didn't last very long. And we were already before then above the band, or trading at least in the upper half of this zone. And you can see here the last time we had earnings at this season in October, we really can't continue down to the downside. So you take a look at some other charts here, the DMI for JP Morgan. You can see how we got the crossover up here, up above, with the ADX up above 20. When you're using this simply as a signal indicator, we've seen these before, and that tends to be relatively bearish for the stock. Of course, nothing's 100%, but that's the signal that people use for the DMI. And crossover above 25, even on the negative directional index, while the positive falls below. So there's some indicators, and of course, the market posture itself with some pressure on it. You say, okay, well, we can sell this. The problem with selling right now the 120 is you don't get enough. So you have to sell the 115, 120 for November. Remember, this is after earnings, so we'd have to account for the risk of the earnings. But you also notice you're getting way too much credit, so around $1.60, $1.64 for a 30% return on risk. You need $1.30 or $1.20 or $1.16 exactly. So around $1.20 here. So we can put a stop limit and say, okay, we'll get into this trade when the credit gets down to $1.20, because that will increase my probability of success on it. Which means the stock has to get down to roughly 110.14 before I get filled in. So it'd have to continue to really break down, kind of ensure this breakdown occurs. We don't get a bounce here. If we get a bounce, we never get filled into the trade. If we don't get a bounce, it continues lower. Then eventually we get filled in. And of course, we want to position size ourselves. You can see right now you got 380. Normally you do probably about 3 trades on this, but in this case we'll do 2. In worst case scenario is a smaller loss than normal at a maximum, but then we'll go for about a $240 loss. We'll try to keep it at a $240 loss. So that would say, okay, right in this area here, 116, 115, what that would say is I won't get in. I don't get filled in until I don't get filled in here until it breaks down. But then if it breaks down, I get filled in. I don't get stopped out unless it breaks all the way back above and completely erases like today's loss here. All right, and that does this for today. So as always, thank you very much for watching our market outlook video, and sorry again for the delay. Again, dealing with technical issues pretty much all day yesterday afternoon, from not having internet access to not being able to even use my camera to not getting things to work here on the system. So I appreciate you working with me and being patient with that, and thank you again for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video, follow us on Twitter for more content, and join our site, subscribe to our site at marketscholars.com with that button up above on the page, on the Market Outlook page, the subscribe button at the top. So as always, thank you all very much for watching. Have a great rest of your day, and we'll see you all next time.